Hey everyone, welcome back to the channel. You work way too hard for your money, right? So today we're diving into a super important topic that could save you thousands. The top tax deductions most people completely miss out on. We're gonna break down everything you need to know step by step so you can maximize your refund and keep more of your hard-earned cash. Let's get started. First up is the home office deduction. Now, this one's a game changer if you're self-employed or work remotely, even if it's just a side hustle. The IRS lets you deduct expenses for the portion of your home that you use exclusively for work. We're talking about things like your home office space, your desk, your chair, even a portion of your rent or mortgage interest. Think about it. If your home office takes up, say, 10% of your apartment, you could potentially deduct 10% of those expenses from your taxable income. That could translate to hundreds or even thousands of dollars back in your pocket. And it's not just rent or mortgage interest either. You can deduct a portion of your utilities like electricity and internet, property taxes, and even homeowners or renters insurance. But remember, the key here is exclusive and regular use for business. So unfortunately, no, working from your couch while watching Netflix doesn't count. Keep meticulous records of your expenses and the square footage of your workspace, and you'll be golden. Trust me, this deduction alone can make a huge difference come tax time. Next up, let's talk about medical expenses. Now, nobody wants to think about getting sick or injured, but the reality is that it happens. The good news is the IRS allows you to deduct certain medical expenses that exceed a certain percentage of your adjusted gross income, or AGI. Now, this threshold can change from year to year, so it's always a good idea to check the IRS website for the most up-to-date information. But generally speaking, if your eligible medical expenses exceed 7.5% of your AGI, you can deduct the amount over that threshold. And we're not just talking about doctor's visits and hospital stays here. Think about things like prescription medications, dental care, vision care, even acupuncture or chiropractic care. The key here is to keep detailed records of all your medical expenses throughout the year. That means saving those receipts, keeping track of mileage for medical appointments, and making sure you have documentation for everything. Don't just assume you won't qualify for this deduction. You might be surprised by how quickly those medical expenses add up. Now let's talk about investing in your future, specifically your education. Whether you're going back to school, taking some online courses, or even just paying for your kids' college tuition, there are some serious tax breaks you need to know about. First off, if you're currently enrolled in college or a vocational school, you might be eligible for the American Opportunity Tax Credit. This credit can be worth up to $2,500 per eligible student and covers things like tuition, fees, and even course materials. And the best part is that up to 40% of the credit is refundable. That means even if you don't owe any taxes, you could still get up to $1,000 back in your pocket. If you're not eligible for the American Opportunity Tax Credit, don't worry. There's also the Lifetime Learning Credit, which can give you a credit of up to $2,000 for qualified education expenses. This credit can be used for undergraduate, graduate, and even professional degree courses, as well as courses taken to improve job skills. All right, let's talk about giving back. Did you know that your generosity could actually save you money on your taxes? It's true. When you make charitable donations to qualified organizations, you can often deduct those contributions from your taxable income. Now, there are some specific rules you need to follow to claim this deduction. First and foremost, you need to make sure you're donating to a qualified charity. The IRS has a handy tool on their website called the Tax Exempt Organization Search that lets you easily check if an organization is eligible. Secondly, you need to itemize your deductions on your tax return in order to claim charitable contributions. And lastly, make sure you keep detailed records of your donations, including receipts, bank statements, and even written acknowledgments from the charity for donations over $250. Finally, let's talk about planning for the future, specifically your retirement. Now, we all know how important it is to save for retirement. But did you know that contributing to retirement accounts like IRAs and 401(k)s can actually reduce your tax burden today? When you contribute to a traditional IRA or 401(k), those contributions are often tax deductible. That means you're essentially reducing your taxable income for the year, which in turn reduces the amount of taxes you owe. It's like getting a bonus from Uncle Sam just for saving for your future. And the best part is, your money grows tax-deferred until you withdraw it in retirement. That means you're not paying taxes on any investment earnings until you actually start taking distributions. It's a win-win situation. You're saving for retirement and saving money on your taxes at the same time. Thanks for watching. I hope this video helped you understand some of the top tax deductions that so many people miss out on. Remember, tax laws can be complex and they're constantly changing, so it's always a good idea to consult with a qualified tax professional for personalized advice. With a little bit of planning and knowledge, you can keep more of your hard-earned money where it belongs, in your pocket. If you found this video helpful, make sure to give it a thumbs up and subscribe for more tips on how to save money and make the most of your finances. Hit that notification bell so you don't miss any future videos, and I'll see you in the next one.